Hey guys, Rajiv here from Financial Hub India. So I welcome you again in the fundamental course we are doing here. And if you're interested to check out the advanced level courses, then please go through our website www.financialhubindia.com. You can also contact us in financialhubindia@gmail.com. Also, you can get in touch with us in the WhatsApp. To get the WhatsApp number, you will have to visit the website. Then you can knock us in the WhatsApp also. So let's get started with the today's topic now. Now, to understand volatile and non-volatile trend, let us first understand what is a volatility in the market. Now, the market can either have two different conditions. Either it can be trendy or it can be flat market, right? If I give you two situations in terms of flat market, let's say for example in Nifty, on a general basis, we can see a momentum of 100 points up and down in it, right? Now, in some day, Nifty opens up and it just moves 10 points up, 20 points down, 10 points up, 20 points down, again 10 points up and 20 points down, you know, creating a small range, which creates a flat market, obviously, because it's moving in a range, isn't it? So here the price range is 20 to 30 points, and this continues happening till let's say 12:30 or 1 o'clock, and suddenly after 1 p.m. you see price moves up, right? And it gives you momentum like this in a range of, let's assume, 70 to 80 points. So what is the difference you see in this 20 to 30 points momentum and in this 60 to 70 points momentum? What is the thing that changed suddenly? The range you see is bigger now. That is nothing but volatility. Nifty was not much volatile in the morning session. After one, we have started seeing the volatility over here. So here you can see this is a non-volatile market and this is a volatile market, right? So in a non-volatile market, what happens? It moves in a small range because there is no much buyers and sellers presence in the market, right? But in a volatile market, there is a larger presence of the buyers and the sellers, which creates the volatility. Someday you must have seen Nifty went up for 100 points in the morning, but by evening it has fallen for 200 points. So that's a volatility. When Nifty was trading in a range of, let's say, 50 points, there were presence of the buyers and the sellers both. And we can expect there is a good amount of presence of buyers and the sellers in this range because it's a 50 points range. So you need good buying push for Nifty to reach from here to here, as well as from here to here. The sellers will have to give their push, right? But suddenly you see a breakout happening here, and then Nifty just flying up, flying up, flying up for 100 points. Now what about this condition then in this up move? So now what we are talking about? A trend. So we understood the volatility in a flat market conditions where there is a larger presence of the buyers and sellers both, which can create a flat condition volatile or non-volatile even. If you have a range like this, 10 points or 20 points range, it's not a volatile flat market. It's a non-volatile flat market. But this is a volatile flat market. So saying a volatile flat market and a non-volatile flat market, we are trying to define the presence of the buyers and sellers, because finally our trading and market is all about the buyers and sellers. Now let's talk about the trendy situations. Now in trendy situation, let's talk about the uptrend first, because if you can understand an uptrend making higher highs and higher lows, then you can easily understand the downtrend also. It's just the vice versa. The concept will be vice versa. That's it. Now let's redraw this entire thing again here. We move in a flat market, then we have a breakout. Another situation I'll draw. We have a flat market, then we have a breakout. All right. So since we have done the minor swings and major swings, so you can recognize what's happening here. This uptrend is going up with minor swings happening in it, and this uptrend is going up with so many major swings. That's the only difference, minor swings and the major swings. And now you will be understanding why we learned minor swings and major swings and how that helps us in our trading. Now, when we see the minor swings, what kind of presence of buyers and sellers do you feel here? It's only buyers. Hardly sellers are able to come in. And every time they're trying to push in, the buyers are so strong, they're just kicking them out. Right? Same thing happens, same thing happens, same thing happens, same thing happens. So it's a one-side market by the buyers. All right? But that's not the case here. Even though it's an uptrend, there is a larger presence of sellers here. Price goes up, falls back up to 50%. And this much fall is only possible where sellers are really trying hard to go down. Again a push up, again a 50% fall. So you can see multiple deeper pullbacks here, right? So the sellers are trying their level best to go against the trend. Even though the winners are always the buyers only, turning from here, right? But analyzing these minor swings and the major swings, we can define the volatility. Right now, how that volatility or understanding this volatility will help us in our trading purpose, that I'm coming for in next 2 minutes. So far what we understand is, whenever you see an uptrend is built up of minor swings, it will be a non-volatile uptrend. Now in this uptrend, since we don't see much sellers are able to come in here and this market is ruled by the buyers itself, then we won't say it's a volatile market. It's not volatile. If something happening in one-sided condition, it's not volatile. Volatility is where there is a presence of buyers and sellers both. Buyers are pushing hard to go move it up, and sellers are pushing hard to take it down. The fight is always there, but you don't see a fight here. There is no fight at all. The buyers are very clear. If some morning you see Nifty started moving up, and by closing it closes 150 points up, and that is the day's high, will you say that's a volatile market? No, it's not a volatile market. It's just a bullish market. If someday you see Nifty goes up for 100 points and it falls for 200 points and again it moves up 400 points or 150 points, then this up down, this is volatility. Then only will be see, okay, for the day Nifty was so volatile. Based on that view, this is a volatile trend. So a non-volatile uptrend and a volatile uptrend. So in a non-volatile uptrend, you won't see much presence of sellers, but in a volatile uptrend, you will see good amount of sellers presence. Now once I clear this point, then I'll move to some charts to show you this volatile and non-volatile trends going on. I want to talk about my trading strategies, not the strategy itself right now, but the kind of trading strategies I follow in my trading and how I categorize all those trading strategies based on this market momentum, liquidity and volatility. So these are the strategies of mine which I categorize in different market conditions. So first of all is our strategies that categorize into two different market conditions, right? What we already know, either there will be a trendy market or there will be a flat market, right? When I see a trendy market going on, then my strategy will be different. When I see a flat market going on, then my strategy will be different. You can't make money using a trendy market trading strategy in a flat market condition. Not possible. There are two different category of a strategy. One will be followed when we see the market is trendy, and the other is when we see the market is flat. All right. Now for the flat market strategy, there is no subcategories, because in a flat market you have this upper range and a lower range, and when price goes down to the lower range, you try to buy it here with whatever other confirmations you want to see, and here when price reaches to the top of the range, then you want to sell it, right? So buy, sell, buy, sell, simple. All right. Now next is in a trendy market. Now when you see a trendy market going on, then it gives you two kind of opportunities to make money, right? You ride the trend and makes money with it, right? If it's an uptrend, then you ride the uptrend, just look for buy signals and you make money with it. And if it's a downtrend, then look for sell signals and go ahead with it. A trend also offers you to make money using the counter trend trading strategies. Like here in this uptrend, price goes up and you see a good pushback, right? Around 50% fall from this top. So you have an impulse move up, then you have a corrective swing down. So you can make money riding these swings up, as well as you can also make money riding these swings down, right? Now here we come with the first reason of understanding this volatile and non-volatile market. If I give you these two market conditions, one is a volatile uptrend and other is a non-volatile uptrend, then which market condition is best suited for you to look for a counter trend trading strategy? Tell me. Definitely a volatile trend, because volatile trend is a trend where we have good amount of counter trend players, but not in a non-volatile trend. In a non-volatile trend, you don't see counter trend traders. There's no presence of sellers. There's no presence of counter trend players. But in a volatile market, you have. So if you have a counter trend trading strategy going against the trend and you want to trade just to take the advantage of this retracement of these swings, pushbacks, and you are using that strategy, counter trend strategy, in a non-volatile condition, then you won't be able to make money because this price is not pushing back here at all. So even though your strategy is very powerful or 90% accurate, but still it won't help you to make money in a non-volatile condition. It will help you to make money when when the market condition is purely volatile and a larger presence of counter trend players are there. Now hopefully you are getting my point of clarifying this minor swing, major swing, volatile and non-volatile, all those things. Now next is when you want to trade in line with the trend also, not going against the trend, but now we are trying to trade in line with the trend, then also we need to figure out whether the strategy we are applying is well fitted in a volatile trend or a non-volatile trend, because when the price moves up, sometimes it doesn't gives you retracement at all. Sometimes it gives you retracement, pullbacks, right? So when we see price is volatile and giving us good amount of retracement or pullbacks, then we look for a pullback trading strategy. All right. And when we see price is just moving up, flying away, in that case, we don't look for a pullback trading strategy. Rather than that, you look for a breakout trading strategy, right? So in a breakout trading strategy, we don't look for pullbacks, but in a pullback trading strategy, we look for pullbacks only. So if you have a strategy where price goes up and then you're waiting for a retracement to happen at least 40 to 50% of the impulse move, let's assume you have a support here, right? So on this pullback, you want to buy it somewhere here on the flip support, or based on your strategy, whatever it is, but it is based on a pullback. But you need a pullback to happen, but still you need a pullback to happen to enter the trades. And in that case, with this pullback trading strategy, if you're hunting a trade in this market condition where there is no pullback happening at all and market is just moving in, and then you won't be able to make any kind of trades actually, even though your strategy is correct, right? So the same goes for here. When you have a breakout trading strategy, right, which is not dependent to a pullback, right? Let's say on a break of every swing high you buy, for example. Let's say that's your strategy, for example. So a break of the previous swing high you keep on buying here, and then a break of previous swing high you keep on buying here, right? So that's a trend continuation strategy, or you can say breakout trading strategy. If this is your strategy, or whatsoever your strategy is based on the trend continuation or breakouts, and with that strategy you are hunting a market like this, a volatile trend, then again you'll be losing money only, because in this scenario every time you buy it above this high there's a retracement happening, so you're in loss. And again price breaks the previous high, which is a continuation strategy for you maybe, then immediately you see price rolling back down for a retracement. So choosing the right market condition for the right strategy is very important. One strategy cannot be applied to all the market conditions. That's impossible, because market condition differs and so your strategy should differ. So this was just an introduction to volatile and non-volatile trend and our strategies, and to give you an outlook for how all our different strategies should be followed properly. Sometimes it happens you have a good strategy, but you are applying that strategy in a bad market condition, in a wrong market condition. And when it fails, what do? We just change our strategy. Like, this strategy is not working out well now, let's look for a newer strategy. And then again it doesn't work out, then again look for a newer strategy. That is how you are just searching for an holy grail for your entire lifetime, right? So sometimes the market condition is correct, but our strategy is wrong, and sometimes the strategy is correct, but the market condition we are applying is wrong, right? So both need to be correct. With the right market condition, you will have to apply a right strategy to make money in the long run, right? So on the next video I'll be showing you a lot of charts on this same topic. So it will be a continuation of this volatile and non-volatile concept. So till then, take care. I'll see you on the next video then. Thank you.